You're talking like the only thing that matters to an economy is interest rates. If you're having a credit crisis, 1/4 point of interest rate cuts doesn't matter for hell.
I don't personally see that there's a credit crisis.
Well, that's what the market was starting to buy into. That's why the banks were down 4% in a day.
The Russian invasion almost exactly 4 years ago of the Ukraine. We know what happened. The emerging market investors didn't listen. They were, on average, overweight in the Russian market. And from the point of view of a foreign investor, Russian assets then went to zero.
And the UK have been taxing our North Sea oil and gas companies. And then the Chancellor in the spring statement turns around and said, would you please pump some more? Having just put all the taxes up. And what do you think they're going to do? No ways. Idiots. Anyway, well, don't get me going. Don't get me going.
We're only down 2.1% on the week, which still leaves us up 16.6%, despite what some could say, almost World War III kicking off.
What do we think is going to happen next, and what that means for running our investment portfolio?
Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results. Welcome to episode 35 of The Art of Investing, brought to you by IG, the global investment platform. That's right, each week we bring you the latest market insights. Of course, it's a very big week in news and the consequences for our portfolio. So, introducing my colleagues here today, we have our very own supreme leader, Chris CJ Fellingham.
Thank you very much, Rich.
And with his luscious long locks to my left here, more like the lead singer of the Supremes, it is Mark Spice Holden.
At least it's not status quo.
Now, we weren't meant to have a guest today, but of course, with the news that we all woke up to on Saturday morning, we thought it would be the ideal opportunity to bring in our Middle East expert.
I think you got it right first time.
JP Smith, of course, our emerging markets hero, to talk all things going on in this Iranian conflict and bringing you the in-depth analysis there. CJ, much happened this week?
Well, I mean, apart from what's been going on in the stock market, I decided to go for a few days away in the Cotswolds with my family. And so that was very nice. But I'm afraid, although the food was fantastic, I saw another sign, or saw more signs of me getting old. And it's getting quite depressing. I was walking with my children. There'd been a lot of water and it was very muddy conditions. And clearly I'm not so steady on my feet as I used to be, because I fell over twice, backside, straight into the mud. And my daughters had to help me up and pick me up. And so I said to them, well, you know, my pride is hurt. They said, we don't care about your pride. We thought you dislocated a hip or something. So obviously they're thinking I'm getting a bit old there. And then also on the same trip, I decided that I was feeling sorry for myself. So I'd buy some fruit pastels and just have a little bit of a sweet tooth. And unfortunately, my tooth fell out. So then I've had to go to the dentist as well with a new crown and filling to be arranged. So I'm getting old, I'm afraid. I need to stay at home and take it easy.
Good. Well, just to let everybody know, we actually had a bit of a delay in recording the podcast today because the studio was double booked. So we've all been sitting out in the sunshine. The pub wasn't open, thank goodness. So we've been sitting in the garden of the pub, and these two have already been going at each other. So either they've spent all their emotion and discussion already, or it could get really spicy. Talking about spicy, let's have that spice market update.
Well, it's been a really, really interesting week. I've spent most of it, obviously, sort of watching the news wires and watching markets and dusting down, looking for my old Yemeni passport just in case it goes the wrong way. But I mean, I think really, normally I'd start this by saying how many all-time highs we've hit, in the normal course of events. But this week, there was a new all-time high, surprisingly, despite actually risk off, as we would say in markets, with most of the equity markets having come back a bit. It was Israel's stock market. The Tel Aviv 35 index was up 4.6% on Monday, the first day after, obviously, the strikes. I guess that's them assuming that, with Iran being taken out, the nuclear threat that's overhung their whole economy is probably going to be taken away. But we'll talk more about that later. On the other side of that, Korea, which has been one of the best performing stock markets year to date, had a massive 2-day fall, a crash. If you remember terminology, if something falls 20% in a straight line, that's deemed a crash. Korea had a crash over 2 days, down 20%, but it's had a good overnight recovery. So it's recouped about half of that, but it's still up nearly 35%, I think, year to date. Wow. So it's still a massively strongly performing stock market. Elsewhere, surprisingly, Bitcoin had a very good week. I think we were just sitting around in the sunshine just now saying, if you were to put money on which assets would have gone down heavily on the day one, you would have probably all said Bitcoin. Bitcoin's actually up about 7% this week. And you'll see that that's come through in our portfolio later. As those of you who follow us will know that we've got a sort of a roundabout exposure to crypto.
And it's funny, actually, at the weekend, when the first news headlines hit, it did drop 3%. And because largely it's one of the very few things you can trade over the weekend, apart from with IG. Well, of course, you saw oil up 16% in the IG weekend markets. You saw the S&P only down 1%, or the NASDAQ and Dow Jones down 1%. So I did think, if oil's up 16, the markets aren't only down 1. So it's quite interesting. There are opportunities always in those weekend markets to take advantage of whatever view you want to express. Was the market not down enough, or was oil too high?
And it was interesting, but it's good on IG to make markets at a difficult time. And like I say, if you feel confident, you can go on and take them on and take the other side of that if you fancy it. But elsewhere in equity land, probably one of the big things, the Sage of Omaha, Warren Buffett, has signed off. This is his last quarter, and he's had a set of results out which were pretty poor, actually. The earnings of Berkshire Hathaway, which is his investment vehicle, was down 30%. Which is a pretty big hit, mainly due to weak insurance profits. And although now I'm sure insurance rates around the world are going to go up because of the Arab conflict, that's one of the reasons that hurt them. And they've had investment write-downs because he's not been investing as well as he used to. But now he's stepping back from working in that business. And I said that was a bit of a hit. On the other side, Apple are putting prices up on their new products, blaming the fact that chip prices or DRAM prices have gone up. And they're seeing bottlenecks in supplies of getting chips through, which, by the way, is one of the reasons that Korea had done so well this year, because some of their biggest chip companies are in Asia, in Taiwan, and in Korea. So that helped there. On the data front, it's been an interesting week. You've had pretty strong data from the US, particularly. We had the ISM, which is the Institute for Supply Management. This gives you an insight into what the purchasing managers are thinking about the world. And a number above 50 means the economy is expanding and people are confident. And it came in above expectations. It came in at about 52.4. And anything above 50, like I say, is expansion. That was good. And the services PMI was even stronger. It's up 56.1. Wow. And that's the strongest since 2022. So, I've been saying some of these tax cuts that are coming through, the One Big Beautiful Bill is going to get some momentum in the US economy. But, at the moment, that's been sidetracked because of what's been going on in the Middle East. They also had good jobs data, the ADP data, which came out at 63,000 against 50,000. In the UK, it's not been such a great story. We obviously would have heard the spring statement from the Chancellor on Tuesday. There was nothing to help the unemployed there. Unfortunately, the 18 to 24-year-olds now have unemployment at 16%, which is pretty horrendous, really. And that's against total unemployment in the country of 5%. But in the statement, she pointed the fact that growth will be going down and downgraded this year. So it was expected to be 1.4% GDP growth this year. It's been downgraded to 1.1, which is disappointing. And next year, it's going to be 1.6. But even out to 2030, they're saying just 1.5%. That's pretty mediocre and pretty poor, frankly. But they do say that magically, inflation will hit their target, which is 2%, remember, by the middle of this year. In the meantime, they think also unemployment is going to carry on going up, ticking up a bit, maybe to about 5.3% by the end of the year. So a bit disappointing from a UK perspective.
The middle of this year?
Yeah.
So we're getting rate cuts then, surely?
Well, you would think so. And we'll talk about some of the impacts, obviously, from what's going on in the Middle East. But unfortunately, with the oil price spiking up, that's put to bed some of the hopes of a short-term interest rate cut, which was potentially due in 2 weeks' time when they have the next Bank of England meeting. Government bonds, we'll talk about how they reacted, but the yields overall were a little bit higher because of this higher oil price. And they were also impacted a bit. Remember, yields go higher when the prices go down. And that was because we had this strong economic data from the US. And so that helped US yields particularly rise a little bit. And remember, we talked a lot about credit, the problems in the private credit market and private equity market. And one of the biggest private equity and private credit companies is called Blackstone. And they allowed their investors to take out just under 8% or redeem 8% of their shares in their biggest fund. And guess what? They managed to persuade their own management to dig out $120 million to help fund that. So the partners of the business sort of had to dig into their own pockets to pay some of their shareholders to get out of the fund. So there are still problems in that private equity market. And there's another big company called Apollo. The chief executive there sees that there's about a 10% correction going on in private credit and private equity. So when Chris talked last week about when these private businesses mark to market or mark to a price, people should expect that to be down about 10%, which is what the guide is from Apollo. Other things to watch out for, some point in the next few days, we fully expect Trump to increase the global tariffs. Remember, a couple of weeks ago, his tariffs that he'd negotiated with each country were deemed illegal. So he then put a blanket tariff using a rule called 122 rule. He put 10% on. That's expected to be lifted to 15%. Unfortunately, the UK is going to be a loser in that because we had already, remember, agreed a 10% tariff with the US. So the UK is going to have to now pay a 15% tariff instead of 10% if that comes to pass. And of course,
we let them use our bases.
Yeah, which obviously we're not going to. We've had a little falling out, haven't we? A little spat with Mr. Trump this week, but it's not great for the UK. But the other thing I wanted to point to as well is we're at the time of year that China look at their budgets. And they come up with a 5-year plan. So every 5 years, they put in place another 5-year plan. So they think long and hard, and they plan long term, which I think is a failing of many countries outside of a command economy, which China is a command economy because they can do that. But where you have elections, each parliamentary party comes and changes it. But the President Xi and his officials will unveil their 15th 5-year plan in the next few days, and you'll start to hear sort of stories about that. But they want to increase consumption, significantly increases some of the quotes in the preamble that they've put out. And that could be quite good for emerging markets and China and hopefully demand in Asia. So yeah, watch the headlines there. You might see a few of it in between what's going on in the Middle East.
CJ, anything catching your eye this week?
No, not really. I mean, I've just obviously won the spread bet for how long Mark could talk about things that were supposedly relevant at a period when the Iran war is going on, and I've just won it because I told you keep going.
Sorry, to put a bet on, you need the other side. There was no offer.
So yeah, I mean, there's things happening last week, but honestly, they're irrelevant compared to the bigger picture stuff. So whilst I applaud my colleague for keeping everybody in touch, you switch back on while we talk about the portfolio first, and then Iran.
Right, let's go straight to the portfolio then. So we had a tough week, but it was looking a lot worse earlier in the week. I will say that we've had a little rally, and that has been helped by the VanEck crypto. So top of the leaderboard, up 4%. Of course, Spice pointed out Bitcoin up 7% just in one day yesterday. The only other market up on the week is our cash holding, that nice, beautiful cash holding that lets us all sleep at night. I don't know, I can't remember who was fighting
I
for
can't
that.
remember who pushed that. I imagine it was a good idea. It was not my idea.
One of the doomsters.
But I just want to go back to the VanEck crypto. I mean, if we'd said to each other, I think last Saturday morning when we heard that the war had started, what do you think the VanEck crypto fund would do for the next week? I think I would be wrong by not only the sign, i.e. it's positive, and I would have thought it was negative, but I would have thought it'd be negative 10%. So that is an incredible performance. And I think that just does show you how badly it had been sold off before, how negative the reactions were to crypto in the first place, but also with the background of data centers and things like that, how worried the market had got about all those things. Yeah. And so what you find, and we'll be talking about this in a moment, is that at times of crisis, the things that everybody are long of, they sell out and they get short or go flat. Everything they're short of, they have to buy back. And so crypto is, I think, being a beneficiary of that, and the sort of data center valuations as well have been. And so well done to the VanEck Crypto Fund and putting in a great performance there. And really, really doing a great diversifying job for us.
So I was going to say, and your timing of the purchase, recent sort of addition to the fund, was actually pretty good, wasn't it?
Well done, Mr. Chairman.
Thanks, JP. I'll take the fiver later.
As a sort of semi-outsider, I must say I'm very impressed with the way that your portfolio is done. It shows the benefits of diversification, amongst other things, but just the way that you've managed to construct it. And I'm surprised, because I would have expected it to be down a lot more than this, given everything that's happened.
But you see, I think that goes to one of the points we made last week. Sorry to just mention it here, but we talked about correlation and we talked about volatility. We talked about all those factors over the last couple of weeks. The VanEck crypto should be correlated strongly with the more aggressive end of the risk spectrum. And the fact it hasn't shows its correlation has changed. Yeah. And that's, as we said before, because the things have got cheap. So very pleased with that. As you say, the cash has done a great job as well. But aside from that, Rich, what else have we got?
So then the bears this week really tell that story of what CJ is alluding to. The overcrowded positions are the ones that have been sold off aggressively. The big performers, that is emerging markets, where we have 10% of the holding, that was down 5.7%. The Japanese Nikkei, of course, had an incredible 6 months. That was down 5.1%. And BlackRock World Mining, again, blockbuster returns in the past 4 months, but down 5% on the week. And India, big part of that EM basket, down 4.6%. So those are big losses. That's more like what we thought the portfolio could have been down. But thanks to the diversification and the correlation game that we had played, we're only down 2.1% on the week, which still leaves us up 16.6%, despite what some could say almost World War III kicking off.
It does show the benefit of that diversification across the portfolio, and where it works for you in your own portfolio construction, where you can have diversification amongst things you believe in, then that is helpful at reducing the overall risk. So yeah, painful week, but actually I would say quite a constructive week. And maybe we could ask that question a bit later when we've finished our conversation. But at a time when some people are claiming that World War III is starting, for our portfolio to be down only 2.1% isn't a bad result, and actually seem to be quite positive.
Okay, quick question. Do you invest in your child's future? IG have just launched their new junior ISA account. And right now, if you open a new account, make your first investment of just £50 or more, IG will match it, dropping a £50 bonus straight into your child's junior ISA. But here's where it gets even better. The first 200 customers to sign up getting an exclusive bonus of £250 just for getting started. Use the code JISA Podcast at sign up. That's JISAPODCAST and get the offer before it closes on the 5th of April. An easy way to start investing in your child's future. Give them a head start. Sign up today. Your capital at risk, new customers only. Offer is valid to the 5th of April 2026 on JISA accounts. Terms and conditions apply. Spice, are there any particular stories in the movers there that we've perhaps missed?
No, I think Chris brought out and touched on probably the most important thing, was that actually people had got very bearish in things like crypto. So when a big event like this happens, people would readdress those positions, maybe want to close off some of the big positions they have. Because we don't own NASDAQ at the moment, but NASDAQ was actually up on the week as well.
Really?
And that's because people have been selling NASDAQ, including ourselves. We had a 10% position, we're out of it now. But NASDAQ was only up, it's up 0.5%, but it was still up in a market where most of the equities were down. And I think, we'll talk about this, but when, Chris and I have sat on big investment committees. When you sit on American investment committees, it's quite interesting because what they tend to do at times of trouble is they basically say, we want to bring money home from overseas. So they will sell things they've invested in overseas. So they would have been natural sellers of the emerging markets of Japan, where they made a lot of money, of Europe, which also had a difficult week, and the UK had a difficult week. They were taking money out of things they'd spent the last sort of maybe few months putting money into. They bring money home. They put a bit in cash because they get cautious. They're worried about what might happen. They put a bit in bonds, then government bonds, and then they put a bit in their own stock markets. And it's interesting, like I say, NASDAQ was actually up on the week, having been probably the worst consistent performer for the last few weeks.
And despite NVIDIA as well.
And NVIDIA had a difficult week. But actually, the Russell 2000 was our fourth best performer. It was only down 0.9%. And remember, this is US small and mid caps. So, that dynamic definitely happens at time of trouble. But and remember, the Americans control 60% plus of all the world's assets. So when they panic a bit, they bring money home where they feel more comfortable. And it was, interesting to me that the markets that probably performed worst were the ones that are either very close to the region in itself. So Europe had a difficult time, potentially in range of the rocket fire, but also countries that are dependent on importing oil from the Middle East and gas.
Yeah, the DAX
and China, obviously big part of the emerging markets. India, big part of the emerging markets, having to be dependent on Middle Eastern oil or Russian oil. And because we'll go on to talk about that, but because some of those supplies have been curtailed, people worried about inflation in those countries and the lack of supply and the cost of higher oil prices. And so those markets, dependent on those oil and gas supplies from the Middle East, also suffered heavily.
Oil prices, it kind of reacted as if we would have expected, right?
Yeah.
But European gas prices, that was the real big move of the week, wasn't it? And that hurts a lot of these energy-intensive companies in Germany and across Europe.
And look, as a consumer, we've got to it's a lovely sunny day out there. You could sit out there in a T-shirt. And actually, natural consumption of things like gas in the UK is coming down very sharply now. It's peaked. It peaks around Christmas time, and then it literally falls as you go through late spring into the summer. And actually, it falls 75% consumption of gas in the UK. So us as consumers, using your radiators, putting the heating on, we're not doing that as much anyway. So even if there's a very short-term spike in the gas price, for the consumer, that shouldn't hurt us too much. But for industrial companies, it can be because they use a lot more of it.
Well, it shouldn't hurt us yet, right? That's the point. Because
now
now is obviously the start of the season of inventory rebuilding. And as I understand it, LNG inventories in Europe are now down to about 30%, which for the time of year is relatively low. So this is the threat, and we'll come on to talk about this more when we discuss the situation in Iran and around the Gulf. The question is, how long effectively will LNG be embargoed? And if it's embargoed for a prolonged period of time, and I think at the moment the market's maybe expecting 3 weeks to a month,
then
4 to 5 weeks, there will be a significant problem for consumers. And of course, the energy price cap in the UK lasts for about 3 months. And then, if you don't get the inventory rebuild, and I think it's down about 12-13% for this quarter, but looking forward 2 quarters, they're going into next winter, there could be real problems.
Can I just say one other thing, just before we get into the debate on Iran? Everyone listening to the podcast needs to understand that the way markets move, they are dominated by the trading community at the edges. The long-term investors will take their positions, long of this, short of that, whatever it is. But it's the traders who jump in and jump out. And there were two things that I thought really, showed you that in the last week. And one expression which I used to love in the city, in the trading fraternity: up the escalator, down the lift shaft.
Mm-hmm.
And so that's what you've seen over the last 2 months. The equity markets have gone slowly up, slowly moved higher. So that's the escalator part, and then bang, down the lift shaft as something happened.
I've heard down the elevator before. I've never heard down the lift shaft.
Yeah, well,
there's
when
not
there's
even
no
a
lift.
floor.
That's when there's no lift. It's gravity. And the reason that's why I think that's interesting is the second thing, which is one of the things I've learned over 40 years. And we did talk a little bit about this last week, about getting complacent. When you get complacent, the market tends to try to knock you out of your position. And that's what you've seen in the last week. All those positions where the market was long, where traders were overweight, I mean, you've talked about it just now, Rich, in emerging markets, the Nikkei, the FTSE, all these things, suddenly the market brings those prices down sharply, forces people to sell, forces those traders out at stop loss levels. So positions now, I would suggest, are much cleaner in that the traders are now much more close at home because they're not really sure where the next moves are. So one of the things that I think is constructive at the moment is we now have a very clean investment environment. But clearly, what is now important is where are things going to go next? And as Rich has already said, we thought we wanted to get our Iranian expert on to talk us through the recent Iranian history to set the scene. Well, he wasn't available, so we got JP to stand in at the last minute.
You've done this line before.
Yeah, it's one of my favourite lines actually, but that's because I'm old and I can't remember what I did before, so that's okay. And then we're going to get Mark to talk to us about what the markets have done immediately, and then we will talk about what do we think is going to happen next and what that means for running our investment portfolio. So over to you, JP. Just give us a little bit of recent history about Iran.
Well, I wouldn't claim to be an expert on Iran. I have actually been there. I was there in 2015 because I was involved with a firm who were about to establish an Iranian equity fund, believe it or not. So the history of Iran really since certainly over the past, since the Iranian Revolution in 1979, is that you have obviously an Islamic, what I would call autarkic regime. So in other words, Iran is largely sealed off from the rest of the world. Now, there are obviously reservations about that. For example, China, Russia, other countries are quite involved. But from a Western economic financial perspective, it's largely been sealed off. Perhaps we should go back a bit further and look at Western involvement in Iran. I have Iranian friends, and actually I have very much in mind at the moment my next door neighbor whose mother is in Tehran. So we should say up front that although this is a financial podcast, we're also all, I think, very mindful of the human element. Her mother in Tehran is elderly. At the moment she can't get to hospital. There are a lot of these younger people, predominantly younger people, who are demonstrating against the regime a month ago or so, who were subject to what appear to have been massacres. We don't know the extent of them. And a lot of them now, a lot of the people who are involved in these demonstrations are probably languishing in prison. So we're sort of mindful of the human element. But if we go back to 1953, that's
when you were born.
a little bit after that.
Coming from you.
Not too long, but a little bit. That was when the British and Americans between them essentially launched a coup against the Iranian government and installed the Shah's and the Shah's father, so the Shah that was overthrown in 1979. So there is a history of Western involvement, also Russian involvement as well, and to many Iranian people, sort of interference. And there is an element of sort of continuity, although this looks to be much more dramatic. If we go back to the Iranian Revolution in 1979, obviously the episode that is very much in people's mind, and you and I have been talking about this, Chris, is the American hostage situation, where Iranian students, initially actually on their own initiative and then later endorsed by the late Ayatollah Khomeini, took hostage a number of American embassy workers. And this hostage situation lasted for 444 days. There was an abortive attempt by the Americans to rescue the hostages at the instigation of the State Department and Jimmy Carter. And in a way, that was, along with the rising cost of living, which was partly prompted by the rise in oil prices after the revolution, was one of the big reasons for Carter being defeated by Ronald Reagan in the 1980 presidential election. So again, we can go back. Since then, what has happened is you've had this sort of patchy but generally escalating pattern of sort of rhetorical and financial hostility between the US and Iran. So you've had the imposition of financial sanctions. You've had the sort of effective sealing off of Iran from a sort of financial and trade perspective from, if you like, the West. Obviously, that's not the case with China or Russia. So virtually, I can't remember what the exact percentage is, but a very large percentage of Iran's oil production goes through to China.
Yep, 25%.
I think it may, of Iran's production, I think it may even be a slightly higher, somewhat higher figure than that. But obviously over time, oil production's fallen. Iran is not as significant a factor on the global oil markets as it used to be.
They produce about 3.3 million barrels, which is about 3.5% of the world production. They're still about the fourth biggest sort of producer out there. They're very important. They're very important.
Yeah, but nothing compared to their importance in 1979.
No, absolutely.
And that was the second oil shock after the first oil shock, which was 1973, when you had the Arab embargo after the Yom Kippur War. So, big rise in the cost of living on both occasions. So more recently, you've obviously had domestic unrest within Iran itself. And so often the sort of big picture shifts in not just emerging but also developed markets are largely conditioned on things like demographics. And the demographics of Iran were one of the big reasons why, so population shifts, one of the big reasons why you had the 1979 revolution. You had a lot of people moving from the countryside into the town. You had a real bulge in the birth rate, and you had people that couldn't find employment and were relatively religiously very conservative at a time when Iran was liberalizing under the Shah. And you had this sort of clash of cultures. And in fact, the Iranian Revolution was really the product of a coalition between various different groups, including sort of left-wing groups and sort of more libertarian groups. But in the end, it was the Islamic faction that very quickly gained the upper hand and supremacy. So, and of course, since the revolution, there's been a further big shift in the demographics. So you've had more urbanization. You've got a relatively well-educated population in the cities. So I was in Tehran for a few days in 2015, and it was striking how sort of, if you like, pro-Western the people that we met there were. And so, and a real thirst as well to engage with the outside world. So when you see these images of the demonstrations that have taken place, to a large extent, this is a population, particularly in the urban areas, of youngish people who really want to re-engage. But roughly 15 to 20% of the population, according to the Brookings Institute, who have got a real expertise in Iran, are people who are very closely affiliated to the regime and would have a lot to lose if the regime were to come to an end. So maybe that's something we can talk about when we look at the various possible scenarios.
Yep, no, I think that's it. So the background is a lot of history between the US and Iran.
And resentment. And even within the opposition in Iran, it's not sort of homogenous. So you have some people that want to bring back the Shah. You have some people who are very pro-Western. You have some people who resent, even in the opposition, who resent the influence of the West.
So a lot of history, but no clear rallying group within Iran for what is going to happen next, and somewhere which has been effectively sanctioned out of the West, and its only real contacts have been with the Russians and the Chinese and whatever. And for those who don't know, of course, the Iranians generally refer to America as the Great Satan.
Well, some Americans do, and a lot of it is performative. You would go down to the sort of central square in Iran, and every morning there would be people chanting "Death to America." Now, I've been there with an American, and people are quite friendly. So a lot of it is quite performative. Sorry, there's another element, of course, that's changed a lot since 1979, and that is the internet and social media as well. So at the moment it's blacked out, but you do have a lot more, in effect, sort of indirect contact between Iran and the outside world. Much more idea in terms of what's happening and what the potential is if there is change.
Quick break, as I'd like to talk about your cash, because right now you could be earning an impressive 7% AER variable interest on your cash on balances up to £5,000 until the end of August. Yes, 7% on uninvested cash for 6 months. If you've been keeping your money in a current account, watching it gather dust, this is your wake-up call. All you need to do is open a new IG account before the 13th of March. Use the code INTERESTPODCAST. That's INTERESTPODCAST, and let your cash do the heavy lifting for you. But don't sleep on this one. The window to sign up closes on the 13th of March. Your capital is at risk, new customers only. The offer is valid until the 13th of March 2026 on ISA, GIA, or SIP accounts. Terms and conditions do apply. Now, back to the podcast.
Okay, so that's Iran and the background to where we are now. And then last weekend, the Israelis and the US struck Iran. Spice, do you want to give us a couple of moments on what that did to markets and where we currently are?
Yeah, look, markets forget the human cost. Unfortunately, they don't really care about that. All they really care about and focus on for investing and stock prices and interest rates, etc., is what the implications are for inflation, what they are for growth and trade internationally and globally, and what that might then mean for interest rates and the earnings outlooks for companies. And that's the sort of thing that as investors we have to look through all the human suffering, unfortunately, and look at those sort of consequences. So there's a natural playbook here. I mean, this is the third Gulf War I've seen in my career, and there have been many other sort of side issues, let alone, Ukraine and Russia, just sort of 4 years ago. So the things you would expect naturally happened on day one. So government bonds immediately went up as a rush to what they called safe haven assets. So that was the first interest was bond prices went up, the yields went down, and then the US dollar also went up. And I say that's a lot of it is Americans taking money out of foreign countries, bringing it back home to America, so the dollar went up.
So that would be a normal war situation if oil was not involved.
Absolutely.
But there's also a fundamental reason for sorry to interrupt you, Spice, another fundamental reason for the dollar being relatively strong, which is obviously their dependence on gas or oil from the Middle East is virtually nil.
Exactly. They're self-sufficient pretty much. Yeah. The other one, the big other currency that really benefits is the Swiss franc. So people in Europe tend to take their money out of other currencies and put it into the Swiss franc, which is traditionally a sort of safe haven. Gold did very well, silver did initially, and oil obviously goes up a lot. But the interesting thing is that it was very quick that those bond prices that having risen, the yields falling, quickly reversed because everyone was then focused very much on what was going to happen to the oil price. And that's what the markets have been looking at day in, day out, hour in, hour out, since the whole conflict began.
So let's just put a little bit of background around this. So just to help people to understand that, clearly oil prices going up means that inflation is going to be higher than expected. So given that markets were expecting interest rates to be cut because economies were going to be weak, the instinctive reaction with oil prices up is those interest rate cuts aren't coming through, and therefore a lot of disappointment to both bond and equity markets. So the bond market move, what you're saying, I believe, is having rallied to start with on flight to quality, then have sold off aggressively on the fact they're not going to get the interest rate moves. That's what you're saying?
Yeah, absolutely. And the big question that the market will still be grappling with for the next few days or next few weeks is how sustainable is this rise in oil and gas prices? Because the longer it stays higher, the more it gets built into longer term inflation expectations. Now, the immediate moves of the bond market was to take out, in the UK, the Bank of England meets in 2 weeks' time. And normally at this point, we'd be sitting in 2 weeks' time going, oh, they've cut by 0.25%. Because the odds had moved very much in favour of the Bank of England cutting it 0.25% in 2 weeks' time. That has basically been almost eradicated by what's been going on in the Middle East. Now, hopefully, they might try and see through it. You never know. But for now, the markets are assuming that 0.25% interest rate that the Bank of England was meant to be doing in 2 weeks' time has been taken off the table. And has probably been pushed to June or July, or at least until we know what's going on in the Middle East. And now the oil price has gone up $10 pretty much from its low just beforehand, and it had been rising a bit beforehand. So there's probably, I would say, $10 to $15 of what you call war premium in there. So if the war finished tomorrow and the oil supplies started coming back through the Straits of Hormuz, now you will have heard many, if you've watched any news program, they'll tell you how important the Straits of Hormuz is. It's the shortest point between Iran and Qatar and all those places. And it's the only area Iran could technically block sort of oil supplies. And 20%, give or take, a fifth of the world's oil and gas supplies come through that little pinch point in the Straits of Hormuz. And that is obviously why people are focused. So there were something like 95 ships, cargo ships, oil tankers going backwards and forwards through the Straits of Hormuz daily. And we're down to about 2 or 3 now. And so basically supplies of sort of that are seaborne, going to China, potentially India, those are the big consumers of that Arab oil, is being cut off, choked off. Now, Trump has already started to say things like, we will give you an armed military, sort of the shipping will arm you, come through, an escort to come through. He's also said, we will insure any shipping that wants to go through it. So the Americans will pick up the bill if your ship happens to, unfortunately, sort of get blown up. It doesn't insure you from human life aspect, of course, but so a lot of ship owners will say, we're not doing it. It's too
exactly, and the captains.
Yeah, exactly.
It's about on you go. You're insured, no problem. Trump has backed. If you do get blown up, don't worry about it. But I don't think there'd be many putting their hand up.
No, I mean, only yesterday.
Depends how high their pay is, doesn't it? If they get danger money, they might. But at the end of the day, what he said is he'll escort the boats as well.
Yeah.
So I've no doubt that he will escort the boats and insure them. He will do both. We need to understand that it's not in anybody's interests, least of all Donald Trump's, for this to go on for a long time, right? He wants the oil price lower. He wants to win the midterms. We talked about this before. We talked about this at the start of the year. He's got the midterms in November. He wants to win those midterms. He is not going to win those if people are paying vast amounts for their petrol. So he needs that oil price down. He needs this to be a small dislocation in the world for a small period of time. That's what he's trying to do. So everything they will be trying to do is to reinforce that this is just one of those things, guys. It'll be over soon enough. Don't worry about life.
He's got military experts. He's said to the world, this will be over in 4 to 5 weeks. Already by yesterday, they have the US and Israeli forces have complete air control over the whole of Iran. The amount of daily missiles that are being fired out of Iran or their proxies, like in Lebanon or Yemen, is diminished dramatically. We're down 86% since day one already in the number of firings, and yesterday it was virtually zero. So they have got control of there. They have got control of this. So the oil price, I think, my own personal view, may have peaked or maybe close to the peak. And this is I want to get some perspective here. This is very different to when Russia invaded Ukraine. Mm. Russia produced 10% of the world's oil. And everyone knew that they were going to be embargoed and that there was a chance that 10% of the world's oil was going to be choked off, right, with no alternatives. Now, the thing about that was inflation was a big issue because the oil price doubled. Literally, the oil price doubled.
Well, and in Europe, gas prices were an even bigger factor, right?
Yeah. And we've learned nothing from that because that was, three and a bit years ago. And the UK have been taxing our North Sea oil and gas companies. And then the Chancellor in the spring statement turns around and said, would you please pump some more? Having just put all the taxes up. And what do you think they're going to do? No ways. Idiots. Anyway, don't get me going. Don't get me going.
I don't think that's really for this podcast, Mark. I think maybe yellow or red cards is coming.
Red for Labour.
Anyway, so look, the point is here at the end of the day, we're dealing with 3 completely different magnitudes of oil supply and gas supply. So 3.5% of the world's oil comes out of Iran specifically. Yes, the other Gulf regions have that. But places like Saudi Arabia have a pipeline that they've got capacity to put 7 million barrels of oil through their pipeline from east to west and take it a different route, not seaborne, but take it across land and into the Mediterranean through Turkey, etc. And that's one way that excess oil could be pushed back into Europe if they wanted to.
Yeah, so there are things like that. The chance of that being targeted, though. I think it's a little bit optimistic to say, right, they've got air superiority. They're just going to pump oil a different way. This is all going to be over. Markets have bottomed. Oil's peaked.
That might be one view, but I am actually a natural optimist, and unlike you Scottish lot.
It's called realism.
Wow. Straight into the Scots already.
There was always a chance that the Yemenis could have done this beforehand. They're all proxies.
Wait, hold on a minute. We're getting away from, we were talking about what's happened. We're now getting into the debate. So we've done what's happened. Okay. What's happened? That's done. That's done.
No, but before we do, let me just finish off on that, right?
We'll finish off and then we'll get on with the debate.
So if the oil price goes up $10, which is give or take what it's done since before in a week, it's gone up $10, give or take, right? There's a rule of thumb that every $10 move in the oil price could add 0.2 to 0.4% to inflation, to annual inflation. Well, that's pretty minimal, right? US inflation was
$15.
US inflation was expected to be 3% a month ago. It fell to 2.4. So, the inflation's coming down elsewhere. Yes, you may have this tap up, but everything depends on how long this conflict goes on for and how long the supplies are cut off for. But the rules of thumb are not scary, in my opinion. They really aren't.
Okay, so look, I think what's key is how long is this going to go on? And I suspect the biggest discussion around here, and probably around all strategy tables, wherever you are in financial centres or governments, is how long is this going to continue, and what, therefore, is the longer term effect? Now, the markets are already pricing in quite considerable moves, okay, in that sense. I mean, for example, we've just talked about bond yields having gone higher, yields higher, prices lower, discounting higher, interest rates expected going forward than were previously being talked about. Okay, so we've seen that effect there. What I would like us to do is to think broadly about how long we think it's going to last and what makes us be optimistic or negative, and come up with a scenario that we think is likely, and then let's talk about the asset moves that we would expect given that scenario. Now, what we've got to understand, what everybody listening to this has to understand, that we are not experts in the sense of we are not sitting there in the Pentagon. We're not seeing what people are saying and do. We're trying to use logic, and that's often a silly thing to do, because logically, why would he have invaded in the first place? But that's another subject for another day. So at the end of the day, I'll start off with what I think, and then please, I'd like to hear where I'm wrong, or whether that's the sort of central scenario. I do not think Americans would have done this if they did not think that Iran was in a particularly weakened state after the responses they saw when the Israelis went in last time to bomb the nuclear facilities. I personally think, therefore, that they think we can get this done quickly. And we know Trump is a guy who does a deal. Mm-hmm. My personal view is he will do a deal with somebody in the next 2, 3, 4 weeks, whatever it is. And it won't maybe be the regime change that some people have talked about. Yeah. It may just be the next faction who JP was talking about. But he will do a deal with somebody. And the deal will be, we're going to lay off. And for that, we'll get some of the contracts to help rebuild this. And we'll be helping, blah, 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 blah. Oil price falls pretty rapidly. Now, if that happens, and we look through this 2-week period, look through this 2 or 3 week period just for a moment. We started off with oil at $70, interest rate expectations to fall.
We started off oil at $60.
Okay, so it's just fine.
No,
I'm not
absolutely
70. The week before it's 73.
Yeah,
Brent, it's now 83.
We announced on the podcast 3 weeks ago that Iran was going to kick off.
Yes,
it was at 60.
I know, but Twice last year, the oil price is higher than it is today.
So let's not argue about things that can be fact-checked. And I've never liked the idea of being fact-checked. When in danger of being fact-checked, change the subject.
No, not fact-checked.
Let's say oil was 65 and just call it that, all right? And I'm sure Brent was if West Texas wasn't.
Brent was.
So say Brent was 665. If you look through all this, and we've got a situation where the conflict is over. Iran is now much, much weakened than it was when it was in a weakened state to start with. I would be very surprised if oil wasn't lower than that 65, which suits Donald with the motoring season starting in America. Remember, he wants to get his midterm vote. He wants to win the midterm votes. What better way than to not sting people in their pockets? You've then got interest rate expectations in the right place once again falling. So if I look through it, forget what's happened, I'm pretty bullish. I could see a very good scenario where people are wanting to buy the market in 3 weeks' time with that all known. And if they do, market won't be trading here. Market will be trading a lot higher. Mm-hmm. And go back to what we said originally, all the weak hands don't own it anymore. They've sold it. They're out. So now we'll be in a position to have a decent bull market again. But what my view stands on is a solution to this. So my weak point then is, what makes this not a quick solution? So JP, tell us, JP.
Can we just say you completely ignored the credit concerns before Iran kicked off?
I haven't, because that's what I said about interest rate expectations will then be falling. Because I think one of the points you make, Mark could have brought up in his spicy market update, was on that Friday before it all happened. There was some serious doubt about some loans that Barclays had and other people had to a UK mortgage lender, if you remember. And they were worried about what that effect was going to be. And that had certainly started influencing some of the bank prices. So I think, had we not had the Iranian situation, we'd be talking about lower interest rates at the start of this week to respond to the fact that there's been a credit issue. And does that mean that we're going to have to cut rates more, which would clearly hurt private equity and private debt because you can't get in and out of those things. But the equity market will be smelling lower interest rates.
Yeah, which is why I mentioned it in the market report that, the big thing with Blackstone seeing redemptions, them having to raise money, Apollo talking about private credit having to be marked down 10%. Those things are going on in the background, of course they are. But this is where I agree with Chris, is that the natural response of central bankers to that would be to look to ease monetary conditions.
You're talking like the only thing that matters to an economy is interest rates. If you're having a credit crisis, 1/4 point of interest rate cuts doesn't matter for hell.
I don't personally see that there's a credit crisis.
Well, that's what the market was starting to buy into. That's why the banks were down 4% in a day.
The market was saying, we don't know who's got exposure here. And so we're going to mark those things down. If we looked, banks have gone up 150% over the last 6 months. So down 4% is nothing. It's just profit
which is why the market's so high. So to get bullish at the highs.
So to me, that's just one of those. It's a blip, but it's no more than a blip.
So you're assuming the credit crisis is a blip and you're assuming that Iran gets done within 3 weeks. So you want to buy.
So the big assumption is Iran 2 to 3 weeks. So go back to that because that's what we want to debate.
Okay, so I put it to you actually that the market's reaction so far has been relatively complacent. So we have seen a sell-off, but in the scheme of things, it hasn't been a very big sell-off. And we were looking back earlier at 2 instances in the past of problems in the Middle East. The first was the first Gulf War in 1991. What you saw there was a protracted period of uncertainty. I was managing European portfolios then, and I just started to reposition towards cyclical stocks. When Saddam Hussein invaded Kuwait, all the markets sold off, I think, by about 15-20%. And the cyclical stocks obviously sold off more than most. Now, I took the view that actually exactly the view you're taking now with Iran, namely that this was a relatively short-term thing and that the Americans and the other allies would make fairly short work of Saddam Hussein. That the market obviously didn't take that view at all. I sort of averaged down into some of the stocks I'd already been buying. And of course, they went down more because the markets were terrified of what would happen. Then we saw when the actual Allied force went in January, February of the following year of 91, we saw the markets recover 15 to 20% in very short order, and we then saw further gains. So that was okay, but they behaved in a very, very different way. They also behaved in a similar way in the lead up to the invasion of Iraq. There was a protracted period of uncertainty. By this time, I was managing money in emerging markets, and I sat with what I thought was a very cheap portfolio for a period of several months. Basically nothing happened. And then, of course, you had the American and, to a lesser extent, the other allies going into Iraq, and you saw then the start of a protracted bull market in emerging market equities. Now, I put it to you, there's been a meaningful change in the marginal buyers and sellers of equities during that period of time. So the difference is that in both 1990, 1991, and during the earlier Iraq crisis, the main marginal investors were institutional investors, and they made what I think was sort of calculated sort of decisions on what they thought might unfold in terms of different scenarios. Now, as it happened, they were actually far too cautious in both instances. But there was this period of uncertainty and the risk premium went up. What we see this time around is that since then, the markets on the margin now are dominated by 3 groups of mainly momentum investors. First of all, you've got the index funds. Secondly, you've got the commodity trading advisors. And thirdly, you've got retail. And what we've seen, for example, in a market like Korea, which had tripled between the start of last year and just before the Americans and Israelis went into or attacked Iran, you'd seen a massive sort of, I can only describe it as a bubble in that market. Of course, as you said, Spice, the market then subsequently retraced about 20%, but was still up around 25 to 30%. And then this morning, I look at my screen and it's gone up 12%. So I don't think markets really are pricing in much of a crisis at all. The only place where you see this to a limited extent is in the natural gas market. And I think natural gas, with regard to what's happening in Iran, is actually far more important than oil, especially to Europe. So coming to the potential scenarios, by the time we can explain what the likely outcome is, then the market has obviously already discounted it.
Before you go any further, you've taken us through two scenarios, right? In both those scenarios, you had a discounting phase.
Yeah.
And then you had it happened.
Boom.
Right?
Yeah.
Well, we've just had a very, very short discounting phase of no discounting, or maybe a week and a half, which, because Richard said already, he was talking about them going in 3 weeks ago, as George Osborne was on one of the on the political currency podcast, which I listened to. He said they're going in. So we've had that phase. Now we've had the action phase. Now, hold on. What happened in the action phase? You have just said both times was the same. The market then rallied because it realised it was a short battle. And that's all I'm saying. We've had the discount phase. We're now in the action is happening. So these are buying opportunities.
Let me give you a third.
No, because these were the last two times.
Let me give you a third instance there, which is particularly close to my heart and to those of other emerging market investors. And that, of course, is the Russian invasion almost exactly 4 years ago of the Ukraine. And that was something, again, that was choreographed in advance. I mean, I did a podcast with a guy about a month before then, a guy called David Roach, very experienced strategist, ex-Morgan Stanley, who was absolutely adamant that Russia would invade the Ukraine. Now, I didn't think they would, because I thought the financial and economic interests within Russia would mitigate against that. After an hour of talking to David, it completely convinced me that they were going to. We know what happened. The emerging market investors didn't listen. They were, on average, overweight in the Russian market. And from the point of view of a foreign investor, Russian assets then went to zero.
Yeah, but
we're not investing in Russian assets.
We're
not investing in Iranian assets.
The problem is that sometimes you get things that happen that are so left field scenarios that they do actually catch investors out. And the problem is with the situation in Iran is that you are at the mercy of events. And, coming back to America, sure, they probably do expect a quick victory. And you know what? Your scenario is probably right. I think it's probably the right scenario. But there's a meaningful possibility that things could go wrong. And don't tell me the Americans know what's going to happen, because they have a history of getting intervention wrong. I mean, Iraq, of course, being
they've not got boots on the ground this time. This is an air, and satellite drone-driven sort of war, right? They're not seeing lots of bodies being taken back in body bags. The Americans have lost 6 people, right? And that's sad. And the Iranians are going to lose a lot more, and they have already lost.
That's sad as well.
Lot more, and that is very sad, right? Because a lot of innocent people but that's war, unfortunately. As I say, we've got to concentrate on the investment impacts. And I believe that there's the power of the Americans and the Israelis together are overwhelming, and they want to make a big point here, because they've got one eye on Russia, and the next thing Trump wants to do is try and sort out Russia and Ukraine, not militarily, but he wants peace there. And at the end of the day, the only thing that I think can damage the investment markets materially is if the oil side of that is damaged for a prolonged period of time. Mm-hmm. Now, the Iranians, if you want to think of a left field thing, the Iranians go around and blow up their own oil facilities, right? They effectively commit suicide on their own oil facilities.
Or they attack the desalination plants in the Gulf.
Yeah, but you take out 4% of the world's oil, give 3.5% of the world's oil supply. But, OPEC plus
Saudi
is
will
still
just
saying that.
pump
So they'll
more.
just pump. Saudi
it.
can do 4 million barrels in about 6 months.
As I said earlier, I'm more concerned with actually the gas market from a European perspective, at least,
we're
and
going
a
into
North
summer.
Asian perspective
Look,
than I am with the oil market at the moment. But the Americans don't even know who they're going to negotiate with. Look, one of the things when you go to Iran or you engage with Iran at any level that's very obvious is you're not quite sure who you're dealing with. Because on one level, and don't forget, they actually have elections there as well, and it applies in the companies. On one level, you meet people who are very much like the people that you'll meet in any other market. And this applies in diplomacy as well. On the other hand, at a higher level, it is an Islamic republic. And that is one of the major issues. So Trump wants to do a deal, but he doesn't even know who he's going to be able to do a deal with. So it looks as though the next supreme leader will probably be the son of the previous supreme leader. And these are not necessarily people who are susceptible to what we would regard as being economically rational or financially rational criteria. Another point is that although militarily, you're absolutely right, Iran has been totally degraded by the Israelis and the Americans, but we've seen in the Ukraine what the production of these very low-cost drones can actually do and the damage. Now, none of us, everybody's a military expert now, right? Of course they are, geopolitical experts. None of us, none of us are military experts at all, so we simply don't know. But a lot of people regard it as being, if the Iranians want to essentially hold out, and if there aren't boots on the ground, then they can continue to fire these very low-cost drones at shipping or at desalination plants or at various other bits of the infrastructure. And we have to be fairly humble. Chris has outlined the most likely outcome, but there are big tail risks to that scenario.
$10,000 to build a drone, $500,000 to shoot one down. That's the
Channel
kind
4
of
last night. Great news.
Well, that is why we're sending a couple of helicopters over to machine gun them, because it's cheaper than the missile.
The Americans can afford it, by the way. It's not like the UK have got to try and do it.
No, my
turn, thank you.
No one has turn 6. I'm the chairman.
Excuse me, JP, your turn. Then we're going to Rich.
I will let you know, but I just want us to be clear. There has to be a tail risk, and I do accept that. There is a risk that something goes wrong in that US plan, and it's a question of where you put that weighting of what that's going to be. Sorry, Rich, over to you.
Yeah, and it leads on to that, essentially, because we've discussed the chance of higher oil price, higher inflation, higher interest rates. But also there's the confidence factor. Now, if this is a prolonged war and it's the first thing in the news every single night and it puts interest rates up or at least takes away the chance of them getting cut, economic confidence is hurt. And that leads to slower growth and lower spending and lower investment by companies. So my fear and potential opportunity is something that we're discussing, that inflation never comes through. Because you've got an inflationary effect from oil, but you've got a deflationary effect from slower growth. Therefore, the bond prices are the ones that are the wrong move, it looks to me, and the potential opportunity. Because if you get economic growth slowing, then the equity market is completely the wrong price. And we're being absolutely, incredibly complacent about this move that are supposedly discounting 1% move. And we already have the risks of a credit slowdown. So the bond market looked primed for an investment, considering that we don't really have any weighting on bonds at all.
But can we get some perspective here? Right. When we talk about when we're talking about equities, we're saying the equities are down 1%. We're talking about US equities there, right? Because European equities are down over 5%. Emerging market equities are down, more than that, and Korea is down, double digit.
But on a 15-month view, Spice, they're still up by big double-digit amounts.
Well, past performances, not necessarily a guide to the future.
Said the momentum investor.
Yeah, exactly. And I think that when you say yes, companies will pull back from investing. Well, they might do in Europe. They might do because Europe's quite close to the Middle East. The Americans aren't. The Americans don't care about that, right? They're still getting a map out and going, hey, where is Iran? They've seen it 3 times before. This is the third time they've had to go at it.
Are you in the cabinet? I'm sure I've seen you giving a press conference for this in the US.
No, but look, the Americans are going to look completely through this and see opportunities, because if they have to rebuild the Middle East, they'll be over there pitching. If there's oil, new oil facilities to be done, they're going to be pitching in there for it.
It's just too early for that, though. Once that happens and once this comes to reality, you're going to have the chance to buy it because there's going to be a lot of money flowing back into the US. But at the moment, the credit, let's not forget the risk of credit. Let's not forget Nvidia went down 10% after its numbers. It just looks to me like it's too early. You're making too many assumptions when you've got big risks. And the oil price could be 85 before it's 55.
My view of this is ultimately you are de-risking the world. This is a massive de-risking of the world. Therefore, a lower risk premium should be attached to risk assets.
Once it's complete.
Yes, but I'm happy to believe Trump, and he's saying 4 to 5 weeks, which means it's probably going to be 3 to 4. But that's my personal view. When you look through this, and remember the equity markets are trying to look 3 to 6 months forward. That's what we always try and say. They look forward. You look through that, you're in a much lower risk world than you were beforehand, in my opinion. Now, the big risk then remains Russia and Ukraine, okay? That is then the outlier, and who knows what could happen there. But we know Trump wants to do a deal there, and if anyone can do a deal with Putin, it's probably Trump, to be fair.
So if I try and bring together some bits of it, we haven't finished the debate, but I'm just trying to bring in a sort of temporary pause in hostilities, as they say. Put away the Exocet missiles, guys, just for a minute. It would seem to me as though no one is sitting here thinking that we should be selling anything.
No.
It's a question of whether you would buy sooner rather than later, that we would all expect there to be a solution at some stage. It's a question of how long and drawn out that is. And I would agree that the longer and more drawn out it is, the more risk asset prices will come down. I think that's clear and correct. So we're sort of agreeing generally in principle, but the big argument is about the length of time it's going to be to get to that chosen land, that end result. Does anybody disagree with that?
I think the risks for Europe, if this were to be protracted, given the emphasis, my emphasis very much on the gas price, if we look back to what happened after the Ukraine, don't forget, the whole business in the Ukraine was one of the reasons why we had such a grinding bear market in 2022. So, and Europe, of course, was at the sort of center of that. And it caused all sorts of other problems, for example, fiscally. So, that affected the bond markets in Europe too. So I would be relatively cautious about this. And actually, with regard even to something like emerging markets, I'm going to sound like a broken record here, and you guys have been absolutely right about this so far. I think actually there is potentially more downside there and in the European markets. The dollar has come out of this looking relatively strong, and I don't know what your scenarios are if this sort of resolution is reached. But obviously the big push behind emerging markets and to an extent the move out of the US into Europe has been the weaker dollar. And, one thing that happens when you get these sort of types of events, sometimes, and we talked about this last time I was on about the rotation within the US market, well, you can get a rotation, bigger rotation than that taking place. And maybe part of the rotation here is maybe out of some of these ex-US markets and perversely back into the US and particularly back into the US dollar. So I just sort of throw that out there. But if the dollar were to be strong for a protracted period, there's no doubt particularly that emerging market equities would come off a lot more.
To be honest, it's the same argument though, isn't it? If it
is.
Goes on for a long time, the dollar will strengthen. Well, so what? Sherlock,
Okay.
We can see that. The issue is if it comes back quickly, goes back quickly to solving the problem, will the same themes that were running before be the themes that are after? And I'll go back to what I said earlier. If they are making a big assumption, the positions are all clean now. The record long, the record short of the US dollar, the record long of euro does not exist anymore. Everybody's flat. So I'm afraid it's one of those things that is really difficult to answer. But which of those scenarios is the correct scenario? And it's all on black or all on red. You can't have a bit of black and a bit of red.
I'll give you an opportunity to have a little bit of black and a little bit of red.
Go on. Oh, I like that. Go on.
What about
more Van Eck? I don't believe it.
What about? And I cannot wait to hear Spicer's reaction to this because it's buying equities.
Whoa.
What about the Wisdom Tree European Defence ETF, which has British Aerospace, BAE, it has Thales, it has all the manufacturers of these rockets, of the defence systems. And it hasn't actually had a big week because people have taken it as a chance to imagine that this will be over quickly. So they've taken it as a chance to sell. And it's been dragged down by the DAX and the weakness in European markets.
I don't mind that as an idea because that plays to my theme of this is a buying opportunity. All I would argue is, or say, and I'll take you guys, the experts, I've not seen a chart of the price. I've not seen how far away it is from its previous highs and how much it's gone up or anything like that and any of those statistics. But in theory, I don't mind that as an idea. And maybe that's good homework for next week for us to go away and look at that to see whether we could justify doing that. Because, of course, I don't think any of us expecting this to be over by this time next week. So we may well have had some bad attacks of some sort or other, which have brought the market back a little bit further, which may give a better opportunity. I'm looking for that sort of thing because I think that this is an interruption to the trend rather than a change in trend. And if things have come back too much, then that's worth having a look at.
Yeah, I think it's definitely worth looking at. When I last looked, it has had a very good run because obviously Trump coming back in and he wants NATO to now put each country to put 3.5% of their GDP into defense spending, which they've not been. And obviously he's now banished Spain from trading ever with America again this week because Spain are not going to do it. But the Germans are, we are, or we're a bit behind the curve, but the rest of Europe is. And that's one of the reasons we were quite positive on Europe as a whole, because that money doesn't just go to defense companies, it flows out into the wider economy and helps other companies.
And the last week definitely has not hurt the chances of governments increasing their defense
absolutely not. I totally agree. Going back to, JP's point, I think there's a big distinction which we have to make sure we're clear of here. When Russia invaded Ukraine, inflation went flying up to double digit and interest rates went from virtually 0 to 5% in a straight line as well. That was clearly bad for risk markets and that initial impact. But, we're way higher than we were back then now. I can't see any way of that happening again, given what's going on in the Middle East. It's 3.5% of the world's oil supplies. Yes, gas prices might go up a bit in Europe.
It's 20% of LNG, isn't it? I
think. Yeah, it is.
Supply.
But they will find other ways again. And this, if they get complete, if they're true to their word and they'll get complete control back of Iran and stop any missiles coming out of anywhere, then that shipping is going to carry on, and it's going to go through.
If they could do that, that would be the case.
Yeah, and I can't see the Iranians being strong enough to fight this off and to do anything to defend it. That's where it's different. And, I get what you're saying, but that you cannot compare this to Russia-Ukraine. You just can't do it. Interest rates went from, let's say, virtually 0 to 5% in a straight line, inflation to 10%. That's not going to happen this time. And the central bankers are more likely, if this gets sorted, supply start going again, the oil price falls $15 or whatever it's going to do, people are going to be cutting interest rates.
So I'm going to draw this to a close here because I hope people have had a clue as to just how difficult it is at these times to really conclude on what you want to do. And it's my job to bring it all together. I like the idea of buying the dip, but I don't think the dip is big enough at the moment.
Yeah.
So I tend to agree with the guys here. Now, there may not be another dip. It may just carry on rallying up, in which case we're long anyway. So
fine.
We're not worried. So I don't see we need to add to risk in that way. I am quite tempted to put 5% of cash into 10-year treasuries. And the reason I say that is because I'm not immune to what Rich was saying about the credit situation before the war on the Thursday, Friday, where this lender blew up. And there's a lot of uncertainty around in the private equity space anyway. And it gives us a little bit of insurance against things getting worse. Because the one thing that I do think the market has got wrong is this instinctive reaction of oil price up, inflation up, bond yields have got to go higher and we're going to tighten rates. We are not tightening rates at any stage soon. Economies are not strong enough to do that. So I'm going to suggest we put 5% of our cash into our 7 to 10 year treasury as our change this week. and keep everything else unchanged. I think it's been a good spirited argument, discussion. I'm sure we will return to this over the next few weeks. But I think let's just buy a few 10-year treasuries out of our cash, just sit and watch for the next week and see what happens.
So what product is that on the platform, CJ?
Last time we bought an iShares 7 to 10-year US Treasury total return ETF, but it will be in the show notes what we decide to buy, and that will be there.
I think it's the same one as we had last time. If it is the same one as we had last time, then that's the iShares Dollar Treasury Bond 7 to 10-year UCITS ETF accumulation units.
Well done, Spice.
That off the top of my head, clearly.
Now, also off the top of your head, can we remember the email address if anybody's got questions?
The art of investing at IG.com.
God, you can really see why it's called the top gear of investing, can't you? Gentlemen, thank you. And JP, thanks again for coming in.
Thank you. Always a stimulating discussion. And actually, don't judge me on this, but I did buy some crypto exposure for the first time ever the other day.
Was it the Van Eck?
It actually was. I'm not necessarily a believer, but I have taken away from you guys that you have to look at the market's internal dynamics more. So thank you.
Well, at least that's made some money for you in an environment where everything else has gone down.
Give us a like and subscribe and leave some comments. We've been having some great comments left for us on the YouTube. Mark does his best at the weekend to answer them. So do I. And we look forward.
Sorry, does that mean I don't?
You're the chairman. You don't have to,
I don't do that,
surely.
I know.
The minions.
That's why you're here.
Yes, sir.
We'll see you next week.